Hey traders, Jeffrey from Ninjacators here. Today, let's talk about what is an order block in futures and how do we use them to execute trades. Order blocks are imbalances in the market. Imbalances where there are a substantial number of limit orders creating supply and demand zones, causing huge market movements. Now, a bullish order block is a blue demand zone. It's the last downward candle before a significant and aggressive upward movement. It's a key level where traders placed substantial buy orders, those big institutions, those big block traders, and it causes the market to rally strongly from that point. It's where the buyers step in. And a bearish order block is this big red supply zone. It's the last upward closing candle before a sharp and a forceful downward movement. It signifies a critical level where traders placed lots of sell orders, resulting in a significant decline in the market. It's where the sellers are stepping in. Now, before we can apply these to trade entries, first we have to understand market structure and price action. Now, market structure is the current movement of the market. It's whether or not the market is consolidating, whether it's in balance, or is it trending? The market moves back and forth from balance or consolidation to trending over and over again. So for example, on this chart right here, this area, as most of you can see, is in balance, okay? It's not breaking out or breaking down, and it's just bouncing back and forth between this area. The area before was trending, okay? Moving down, then moving back up. Not significantly enough for us to see it reaching either of these demand zones or supply zones, but enough to see the difference between a consolidation zone. Now here's what you do. You keep your eye on the market for areas of consolidation or balance just like this. And then, once we watch a breakout of this area, we're going to look for it to move to one of these zones and get an idea whether or not the market's ready to reverse or progress through those zones. And here's how we do that. So we're going to take a line and connect from a low to the next higher high and then to a higher low. But then if we see the next point is a lower high, we know that we've got a reversal coming. And sure enough, this point is going to come down to a lower low, a lower high, another lower low. So when we see the market reach this zone, then we know that there's a likely reversal coming. If it would have passed through, it would have invalidated that zone and potentially gone higher. We're looking for the reversal, and we would have jumped in right after this lower high and ridden it all the way down. So remember, we're going to determine the direction and likelihood of continuation or reversal of these trends with price action. Bullish trends are going to be identified by higher highs and higher lows. Bearish trends by lower highs and lower lows. Other things to learn about and keep in mind, you've already heard of them. We're going to identify double tops when we see them, head and shoulders patterns, triangles, flags. And the great part is our supply and demand real-time zones mark these supply and demand zones for you. You don't have to plot them out. They're going to appear on their own and disappear when they're invalidated. And that is all there is to it. Once you get comfortable, you'll soon recognize higher highs and higher lows. You don't have to plot them, but in the beginning, I strongly suggest you take a snapshot, mark them down, look where they intersect with the supply and demand zones, and take your trades. Good trading. We'll see you next time.